The article I selected is called Government's New Normal, A Changing Role for Auditors. I chose it because I work for a municipality in Connecticut and because that municipality, along with all the others in the state, are facing the strain caused by state budget cuts. The article was written in 2013 and focuses primarily on the 2007 economic downturn and the effects on state and local governments. As a result of the 2007 economic downturn, state and local governments have faced historic drops in revenue, increased long-term obligations, and more stringent pension recognition rules, which I will go over in detail in future slides. The decreased governmental revenues were a result of sales tax reductions because consumers began to spend less or defer their spending, and property taxes. As part of a vicious cycle, unemployment went up, foreclosures went up, less construction started being done, and as a result of all of these things, property values began to decline. At the same time that revenues began to decline, long-term obligations began to increase as governments issued additional debt to meet financial obligations and began to defer contributions to such things as pensions and other post-employment benefit obligations, increasing the amount that would be due in future time periods. As state and local governments tried to recover from this reduction in revenues and increase in obligations, more stringent rules for pension recognition were coming into existence as well, requiring that governments now recognize net pension liability, or NPL, on their balance sheets and recognize pension expenses on their income statements. This would make shortfalls more easily recognizable, and these new standards could potentially affect a local or state government's credit rating and ability to issue debt. For fiscal year 2013, 31 of the 50 states had a budget gap, and this is despite the fact that 49 of the 50 states have balanced budget laws on the books. The only state that doesn't have such a law is the state of Vermont. A study by the Center on Budget and Policy Priorities report revealed that for the prior economic downturn from 2002 to 2005, the state shortfalls had been approximately $240 billion, but between 2009 and 2012, the shortfall was more than double that at $538 billion. Some of the coping strategies that an auditor may focus on when reviewing the financial statements of a government entity is spending cuts and scaling back operations, increased fees and taxes. They may have received additional federal stimulus money. They may have had to withdraw funds from reserves. They may have underfunded their pension and OPEB obligations, or they may even have skipped debt payments. The results of this economic downturn may continue for many years to come. The State Budget Task Force predicts that the issue will continue long past this cycle due to healthcare costs soaring, pensions being underfunded, federal budget cuts, and infrastructure needs increasing. The CBPP predicts the revenue will not rebound until 2019. Some municipalities have even turned to bankruptcy. The four mentioned in the article are all in California: Vallejo, Stockton, Mammoth Lakes, and San Bernardino. Bankruptcies were fueled by the massive property foreclosures and the resulting loss of property tax revenue. This latest economic downturn presents unique challenges to auditors. It's critical that they know the client or government entity that they are reviewing. They understand the current economy, and they be forward-thinking, because history in this instance is not a good guide, because things have changed. In this current economy, there's an increased need for the auditor to assess decreased revenues, going concern issues, short-term projections, a newer, greater IT demand, use of estimates, and investment volatility. Decreased revenues have a vicious cycle on a governmental entity. As revenues go down, layoffs and furloughs go up. And as there are fewer employees left on the payroll, sometimes duties are combined into things that shouldn't necessarily be under one person's control, resulting in less oversight and reduced separation of duties. During a time of financial stress, this could very easily result in fraud. Unlike in years past, an auditor actually has to evaluate whether a governmental entity is a viable going concern, whether they will be able to sustain in the current climate. The CBPP predicted $55 billion in state debt for the year 2013. And some governments may project the same level of revenues year to year, though the climate has changed. Others may project a budget with less revenue than expense, despite the fact that balanced budget laws exist. And there's little help for struggling municipalities, as state and federal governments also are feeling the strain and don't have the resources to bail them out. The SEC is pushing to have CAFRs come out sooner, with interim reports in between, so that stakeholders will know where they stand. There's more state debt, $4.7 trillion, with municipalities carrying $2.7 trillion. The questions an auditor must be thinking about in terms of going concerns are, can the entity generate enough revenues to cover costs? Do they have the ability, credit rating, to issue debt to fill the gap? And can they make additional cuts? Does the governmental entity just think about the next cycle, or does it have a longer-term view? Unfortunately, many state and local governments have a kick-the-can-down-the-road attitude and are only thinking about the next budget cycle or the next election and not a more long-term view. The article mentions the state of New Jersey and how the SEC issued a cease and desist order for material misrepresentations and failure to disclose pertinent information related to 79 municipal bonds totaling $26 billion. In addition, between August 2001 and April 2007, they failed to disclose underfunding of two of the largest pension plans in their official documents and state treasurer's report. It made them appear fully and adequately funded when that was not at all the case. Another big challenge in recent years for auditors is that of assessing information technology. Many auditors choose to work around rather than through the IT system. They may actually need a specialist on the audit team. Advances in programs and databases make it so that they need to question who initiates code, who makes changes, and what do the changes do. There are actually software packages called Enterprise Resource Planning software that have their own artificial intelligence and can change themselves in reaction to entries. Auditors need to test for this. Segregation of IT duties is critical. Financial managers should never have control over the software. An auditor should test estimates for reasonableness. They should scrutinize any changes in salvage value or estimate of a useful life. If the governmental entity is using the modified approach to infrastructure, the auditor should test if the equipment is maintained at the proper level. And if there's any changes to the allowance for doubtful accounts, that should be scrutinized, as it could result in additional revenue recognition. And investment should be assessed for reasonableness in terms of returns. Both government staff and auditors should understand the methodology for determining investment value and the risks and likelihood of impairment. Auditors may need an expert if the portfolio contains hedges, derivatives, or international holdings. So, as mentioned previously, an auditor may need to employ an expert if in terms of investments in IT. But that doesn't relieve their responsibility. They need to understand the findings that they get from that expert. The PCAOB AU 336 stated that auditors should obtain an understanding of methods, assumptions of an expert. They should test the data supplied to the specialist and evaluate if findings support assertions in the financial statements. So, who is an auditor to trust in this type of atmosphere? Financial pressure, opportunity, rationalization are common to corporations and governmental employees. The cost of fraud has nearly doubled between 1996 and 2008, with 2008 having the largest increase. Between 2006 and 2008, managers and non-managers had about an equal instance of fraud, but the interesting thing that was found through studies was that the higher the educational level, the higher the fraud dollars. The city manager in Bell, California, was found to have split his salary over many departments, and his total salary actually came to $800,000. The Association of Certified Fraud Examiners found that 80% of fraud was due to corruption, billing schemes, and non-cash asset theft, with a median loss of $81,000.